And welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread, and today I'm joined by another one of my colleagues, Mr. Jeff Jetter. How are you, brother?
I'm doing very well, thank you.
So, Jeff, since you and I were on the podcast a little while ago, something major has happened in your life, unbelievably major. Tell me about it.
Well, a couple big things, but the big thing I think you're talking about is I did pass my CFP exam, and I've gone through all the credentialing criteria to get my CFP certification.
Friends, I got to tell you, that is a huge, like monumentous, like magnormous, over other crazy words you can make up, magnificent, unbelievable, just ginormous. See, all these crazy adjectives here. That's a huge accomplishment, dude. I'm so happy to be a colleague with you, and dude, I'm unbelievable humbled that you'll have be able to share that wisdom with our listeners on the podcast, man.
Well, I appreciate you saying that. I put in a lot of work to get there.
So today, friends, we're introducing Jeff as a regular. Now, he was on the show not too long ago, and those of you may remember a particular informational point we did. But what we're going to do is Jeff is going to come on the show about every other week now, and we're going to start answering personal financial questions. Now, we get a lot of questions from our clients, as you may know, just from talking with us on the show or listening to the podcast or the videos. This, by the way, is on YouTube, not only on iTunes or Stitcher, Spotify, wherever you may be listening to it on the podcast. But we get a lot of questions from our business clients, and we work with hundreds of business clients nationally, all across the country. And Jeff's primary goal as the Director of Financial Planning here at Heritage is to work with business clients to make sure their home life is in good working order, that it is efficient and productive, and it's the least of our business owners' worries, because the business side of things just drives us crazy. So Jeff is listening to hot topics in the media, hot topics coming from our clients, and for those of you who reach out to us on financiallysimple.com/ask Justin, I shift over some of those questions to Jeff, and he'll be answering those in his segments on the Financially Simple podcast. So, brother, I'm super excited that you're going to kind of jump in on these personal financial questions for business owners. Whenever we think about this, Jeff, why is it that business owners, myself included, you and I've talked about this, why is it that we often forsake our personal side of planning for sake of the business? What's your thoughts on that?
Well, I think primarily it's because we think our livelihood comes from the business. So we will invest as much time, effort, even resources into the business to make it as successful as we possibly can. Sometimes we neglect our personal responsibilities, our personal finances for that, because we think we're doing it for the better of the company.
You know, we often say the Cobblers Kids' shoes are never shod. My dad said that my whole life. Have you ever heard that statement, Jeff?
Of course I have, and I know exactly what you mean by that. Yep.
So in our world, the financial world, oftentimes we, financial people, are the worst clients, and we actually are often end up being very broke because we work on everybody else's lives before we take care of our own. But we had a question come in this week that I think is just right on point to a fundamental discussion that so many business owners, myself included, have had. And here's the question. And this is what I want to dissect with your mind today, Jeff. The question is, what's the difference between a non-qualified account? And friends, we talked about that, by the way, on the podcast at length. What's the difference between a non-qualified account, an IRA, and a Roth IRA? And why should I choose one account over the other? So let's kind of lay the foundation here, Jeff, as we kind of dive into this. In the personal financial world, I realize it's my belief, and those of you who've listened to me for any length of time on the podcast, I believe that my business is my top performing asset. I really do. As I'm looking at my business, I also believe there may be a possibility. In fact, only 14% of businesses actually transact for a sale or for a value that moves it from an illiquid asset to a liquid asset for the business owner, only 14%. So that being said, I realize that I have to set some cash or some investments outside of my business. Now, the very first place I look at is real estate because I like it and I've dealt with it a long time. But I also have a ton of money in different investment accounts. Now, I'm not a big fan of Wall Street. You've heard me say that, Jeff. I don't like Wall Street. But ultimately, they have these three types of accounts, which if I utilize them properly in my personal business planning, then they can add some long-term value to me. So I want to lay that groundwork first, friends, that I haven't changed my tune. I still hate Wall Street. It still drives me crazy. But just because I hate it doesn't mean I can't utilize a lot of the tools to help me maximize my net worth growth. So is any of that shock you, Jeff, as I talked in that way as a business owner?
Not at all, and especially for the business owner. The one asset in our portfolio that we can control as business owners is our business. We have a lot more hands in the pie, so to speak, on that. Whereas your portfolio, we are up a little bit to the whim of the market.
So let's dissect them. What's the difference? Let's go to the very first part of the question. What's the difference between a non-qualified IRA and a Roth IRA?
Okay, so really we've got tax strategies here is the biggest thing, and where and when do we pay taxes on certain investment assets? So your non-qualified investment account, that's probably the easiest one to explain. We put that into a taxable investment account, whether it be mutual funds or direct investment portfolio, and we pay taxes on the money that we put in there. Perhaps we got that from our business income. Perhaps we got that as a W-2 employee, but we paid taxes as we got that income. We invest that money, and as that money grows, we pay taxes on the growth of that. So it goes back to that my money makes money. Well, the money that my money makes, the government wants their cut too, right? So that's a taxable investment. Is that pretty clear?
Yeah, I'm with you. So let me just say back what I think I heard
Sure.
you say, okay? Because you know me, I like to be financially simple. No pun
Of course.
intended there, friends. Okay, so here's the deal. I make money, whatever it comes in, I put it into an account, I invest it however I'm going to invest it, and I pay taxes on the earnings.
Correct.
Simple?
Yeah, and really with those type of accounts, there's no rules on that money. That's your money.
What does that mean? Does that mean I can do whatever I want to with that money?
Absolutely. So you invest that, you can withdraw it at your leisure. Now, depending on your investment, you may have risk, reward, that sort of thing, but we'll get, that's another topic.
Right. Okay, so let's then switch to an IRA or an individual retirement account, maybe even a 401k, because they kind of all fall within the same tax status as you're talking about.
Okay, so we're going to switch all the way to the other end, and this is a tax deferred, a pre-tax tax deferred investment or savings account. So we're going to put this money aside. We're not going to pay income tax on this traditionally. So this is going to be our pre-tax money. The easiest example is your W-2 employee who gets their income. They would pay their income tax on that income, and then that money goes into their checking account. Well, this money comes out pre-income tax. It goes into an investment account. It then grows tax deferred as well. Now, we've got two really great advantages there. It's pre-tax dollars that go in. It grows tax deferred. But when we take that out at retirement, we're going to have to pay Uncle Sam his cut. So that's when we get taxed on that.
So if you said that's at the far extreme, that was a pre-tax. In other words, we don't pay money, we don't pay tax on the money we deposit, but then when we take the money out of the account at some point in the future, we pay taxes at that point. So Jeff, if now we talk about the Roth IRA, we talked about the non-qualified being over here on one side, and you said the IRA was maybe an extreme. Do you consider the Roth IRA about halfway between, or are they going the opposite direction, so to speak?
No, oftentimes what we think about is the Roth is sort of in the middle. And the reason we think of it in the middle is because we've got funds that come in what we call after tax. So we've paid our income tax on this, whether it be through our business or through a W-2. We've already paid our taxes and we make those investments. Now, the neat thing about a Roth IRA is now it grows, but it grows tax deferred. Unlike the taxable account, this one grows tax deferred. We don't pay taxes as it grows. And as long as we abide by the rules of the IRS in accordance with a Roth IRA account, when we take those funds out, we get them, quote, tax-free. The growth is tax-free. We don't have to pay taxes again on that money.
Okay, so let me just kind of recap from my mind here, those three different things. It says kind of before we go into the next section. A non-qualified account, as we look at that, Jeff, we're going to say that account is we place money in after taxes, and then every year we pay taxes on the gains or losses, depending on what it is, of that particular account. That's non-qualified. An IRA, as you described, it means that we are receiving money, but we're putting it into an account pre-tax. In other words, we never pay taxes on it. And then we take it out at the approved upon time. We pay taxes on the gains plus our original contribution. And a Roth IRA, if I understood you right, we're going to go ahead and pay taxes on the income now, We're going to place it into a Roth IRA. It's going to grow tax deferred. And as long as we utilize it correctly, then the growth plus the contributions all come out tax free. Does that sound right?
That's exactly right. And I don't like to talk specific numbers on podcasts because it's really hard to see numbers when we're talking about them, but sometimes the example is better. So if I could break that down into an example with real numbers, simple
Okay.
numbers, but real ones. So let's take $100. I've earned $100. Now, for me to get that $100 into my checking account, I'm going to pay Uncle Sam, let's say 20%. So $80 goes to my checking account. Well, if this is a taxable investment account, I'm going to take my $80, which is what I have left. I'm going to invest that. It's going to grow at whatever the growth rate is, and I'm going to pay taxes on that growth as I go. I can take that money out as much or whenever I want. There are no rules or restrictions. With the Roth IRA, I'm going to take that same $100 that I earned, pay my taxes to Uncle Sam, so I have $80 left. I'm going to invest that. It's going to grow, but I'm not going to pay taxes as it grows. And then when I take that money out, as long as I follow the rules of a Roth IRA account, I will take that out and not have to pay any additional taxes.
Okay.
And with a taxable account, I take the $100 that I've earned, I invest that before I pay the $20 to Uncle Sam. It grows tax deferred. But then when I get to the point where I'm taking that money out of the account, I will have to pay my income taxes at that point on everything.
So Jeff, I wrote an article on the blog, and I think I did a YouTube video on this one a couple of years ago, talking about the advantages and disadvantages of placing money into a Roth versus an IRA. And man, there's all sorts of articles out there that's talking about the advantages and disadvantages, running out illustrations, pie charts, timetables. I've done those myself for even some of the national media. I hear pundits, I like to use that term, TV talking heads say to only do this, whatever this is. I've heard them say to only put money in an IRA. In fact, one of my heroes in the financial world, who's a really big, popular individual in the financial world, he says only use an IRA. And then I have some non-financial professionals that say only use a Roth IRA. Is it as simple as only, or is there a time and place for IRAs and Roths? And then let me ask you a third question as you're kind of dissecting, which is this, guys, in a podcast, or this is a no-no. You're not supposed to ask three questions. So is there an only? Is there a time and place? And if someone chooses an only personality or an only way, one way or the other, are they hurting themselves? So those are the three questions I want to unwind with you, okay?
Yeah. Let me start with the easy answer, and that is I'm not going to answer your question. Of course there is no answer. And yes.
Time out, Jeff. Why isn't there an answer?
Well, because everything is situational. So your circumstances may encourage one of those accounts over the other. But really what we like to encourage as an overall philosophy here at Heritage is diversification of those tax buckets. If you think about a diversified portfolio being protected, you also want to think about a diversified tax strategy when it comes to investments.
All right, time out.
Okay.
You've lost me for a second here, okay? Why is it that my situation may be different than somebody else's? I mean, I've listened to the talking heads on the radio, and they tell me that I should only do this. Why is that not the case? You're telling me now that I may be in a total different situation than somebody else. Give me an example.
Well, for example, when we look at a single dollar in any of those tax investment buckets, those dollars don't exist in a vacuum. So that dollar doesn't exist all by itself to go through either a Roth, an IRA or 401k, or a taxable investment account. It works with your other investable assets. So what we like to do is we like to make sure that we manage those assets into a diversified portfolio or a diversified tax strategy. And what we're looking at here is how does it work with the other dollars in your investment strategy?
Okay, so let me see if I can say back to you what I just heard you say and see if I'm explaining, see if I heard what you said accurately. Okay, so I'm a business owner. I have a business, I have real estate, I have some IRA, non-qualified, and Roth IRAs. I have $1 that I want to put somewhere. if I heard you correctly, there may be some periods of time whenever I want to deploy that dollar in one of those 5 directions, and the very next month, year, situational event, et cetera, I may want to deploy that dollar into a different direction for various reasons. Am I saying what I think I heard you say?
You're saying that exactly right. Yes, each dollar doesn't exist all by itself. If we do the pure math, first of all, we have to speculate on the future, which is really hard to do. But if we just look at today's facts and project those to the future, your single dollar may be better used in a Roth IRA account, for example. However, in today's environment, you as the business owner may get a significant tax break if we can reduce your overall income, your net operating income or your adjusted gross income, depending on how we're applying your tax strategy. So what we want to do there is we want to look at ways to use that dollar to better manage and more effectively manage your overall tax strategy and your overall saving strategy. And even that goes into your overall portfolio.
Okay, I'm with you. I'm with you now. So before I rudely cut you off, and before my phone rang behind us as we're doing a podcast, which is always great, friends, and we're not going to edit that out. Me sitting there going, keep going, Jeff. The phone is ringing behind me. It's because one of the wealthiest clients in the world just called and said, hey, Justin, we need your help. By the way, they're saying, hey, Justin, I saw you had new glasses, and you look super awesome in the new glasses. Now, I know that's what you're thinking, friends, so go ahead and leave me a chat below. But I'm not going to edit out the phone because that's reality here, guys. That's the reality of the business world. But, Jeff, back to what you were saying before. The phone rang and I rudely interrupted you. We're trying to then figure out how, for a business owner like myself, how to maximize the tax strategies.
Correct.
And we're looking at 3 different accounts that has 3 different tax strategies. How do we make the decision on which account to use or which style investment to use? Because I think my business, the way I look at my business is in the taxable account. My real estate investment could be in the tax deferred account. If I did an exchange on it consistently, I could probably make that argument. Some would say maybe it's in the taxable account because I had to pay tax on every year, but I could argue it's in the deferred account. The Roth, I can't really put my business or real estate in the Roth directly. I can do some other shenanigans to make it happen. But if I'm now trying to figure out how to reposition my life with these 3 types of accounts, how would I make the decision on how to diversify that dollar that is not in a vacuum to one of these accounts versus the other?
And what you just said is probably the most important part. We want to take that diversification strategy. In other words, how do we use each of these tools, not just one? We want to use all 3. I'd love to use all 3. And so we've got to figure out for your goals, your specific goals, how do we best utilize each of these? You also have to remember there are a lot of rules and restrictions. So for the pure qualified, the IRA account, there are a lot of rules on to when you can use it, how you can use it. For the Roth, there are rules on how much we can put in, when we use it, how we use it. So we've got to make sure that we've got liquidity in your taxable accounts, as well as your retirement wealth building strategies.
If I were a DIY type of a planner, what we're seeing is, especially with the COVID situation globally, that DIY has caused some problems for many people. Mm-hmm. But if I were a do-it-yourself investor, DIY, I should say, not DIY, DIY investor or DIY financial planner, how might I go about trying to figure out which one of those accounts to deploy my dollar toward?
The first thing we need to do is identify the objective of the dollar. What do we want that dollar to accomplish for us? Is that going to be our retirement nest egg? Is that going to be something we want to use for investable assets or options or opportunities in 10, 20 years? Or is that something I need to have access to today? What is the purpose of my dollar?
You know, as you say that, I think one of the biggest pitfalls I see business owners make, Jeff, is they don't realize that there's several rules on when we can use the dollars. You know, we see a lot of people, and you and I are working with business owners, me from the business side, you from the planning side, where they say, hey, look, I don't want to be doing this at age 60. I want to be retiring on the beach. I want to be jetting around the world, you know, having a good time. And in fact, we were talking with a client about a week and a half ago. This looks like he's going to be able to sell his business in his 50s if he were to take all of his money and deploy it toward IRAs or 401ks pre-tax, we potentially could run into some problems, couldn't we?
Well, we certainly could. We wouldn't have any assets available for that early retirement scenario that you just mentioned. So the IRA especially, we can't really touch that until we're at retirement age. Right now, 60, 59 and a half, 60. So if we were going to try to retire early, now we may be able to get the liquidity we need by selling the business, but we may not.
Well, so we could potentially sell the business and get some liquidity there. We may end up having some self-canceling installment notes. We may end up having to do a sell or carry note, which then we have high risk in that scenario. We could do a 72T calculation, which is a whole other podcast for another day on IRA. The Roth gives us in a position where really the only thing we can really take out of that is the contributed account. So if I were trying to retire before age 60, then I really have to be pretty astute to all the various options. Is that correct?
Yeah, absolutely. We want to take advantage of the tax deferred growth, but we don't want to take advantage of that at the expense of current or short-term availability.
Now, what if I was retiring after 60? You know, you and I have talked about this ad nauseum, that there is a sweet spot, so to speak, depending on the situation of life, that none of us know what it's going to be in 5, 10, 15, 20, 30 years, whatever age we are now. But as we're working with retirees today, Jeff, you were showing me some of the sweet spots that, you know, we can control the 3 valves and let the flow come from those 3 valves differently depending on the retiree's particular position that year. So I'm thinking of, here we are in 2020, and part of the CARES Act, it says that requirement of distributions are not needed this year. We don't have to take them. In fact, the legislation as of today is still talking about maybe even next year we won't have to have RMDs, which is interesting. So we could then, if we only had 1 bucket full of IRA money, we could end up not being able to utilize that particular strategy. But if we had Roth and non-qualified accounts, am I thinking correctly to say that we have 3 different valves or levers to pull to help minimize a taxation during retirement if we built this thing right?
Yeah, exactly. And it goes back to that each dollar doesn't work by itself. They all work together. So you could be looking at a strategy. I mean, let's take something as simple as a W-2 retiree looking at Social Security. We might not want to turn on as much of their IRA money as we could, because we would have to pay, we'd have a higher tax burden on their Social Security income. Yeah. So there are all kinds of different effects that we have by increasing or decreasing the amount of taxable assets or taxable income we have available.
So Jeff, let's bring this plane to the ground. Okay, so as we're talking about this, we have 3 different accounts. They all have different rules on them. My business is a taxable account. My real estate is taxable. Some could argue tax deferred, depending on how you're going to structure it. But then we have some other monies that I call slow money that I'm still saving and using some efficiency on. How in the world, dude, can your division, your department, financial planners, CFPs nationally, how can they position a client with all those variations that we just talked about? And all the variations and hypotheticals into the future. How in the world can you position a client today to maximize the possibilities of success in the future?
Well, again, it goes back to that one thing, that is, what do we want the dollar to do for us? So when we start to look at what are our specific goals, then we figure out the most efficient and effective ways to get to those goals. Typically, it is a mix of these 3 different tax buckets, if you will.
Does it change?
Now it's just a matter of which bucket do we want to resource first.
Well, does it change from year to year? I didn't ask you that question. I think I use it as an example. Might we put money in one bucket this year and the money in another bucket next year?
Well, certainly. And again, it all comes back to what are we trying to accomplish and what are the advantages of each in our particular situation. Matter of fact, the question where this came from a client who was specifically looking at some healthcare tax credit issues. And so what we were looking at was not necessarily the most effective long-term savings strategy for them, but how do we make sure that they don't get themselves into trouble about losing some credits because their AGI was too high or adjusted gross income was too high this year?
Friends, we're going to bring this plane to the ground now, and here's why. We can jump into some deep rabbit holes really fast. Every situation is different. I tried to give you some in-depth look at the various questions that I would have as a client, and Jeff did a very good job at explaining that it's all different. I put Jeff some very hard questions out there, especially when we're on audio versus in front of a whiteboard that I know he would love to be standing in front. Isn't that right, buddy?
I do like to doodle.
So I know he'd rather be on a whiteboard explaining this, but here's the deal. Through this COVID situation that we've all experienced globally in this last little bit here, as we're recording this in mid-May of 2020, we have recognized more than ever the need for advisors because of complexity. And I got to be honest with you, as a business owner, I often thought my business was the most complex thing I deal with. And candidly, it is complex. Trying to figure out how I'm going to shift some monies around to make sure we hit payroll so we can hold our team and all those various things. It's tough. Being a business owner is tough. But here's the thing that we don't want to do. We don't want to become a statistic. At the end of the day, we may be able to build a rock star business that may never be able to be sold or transferred. It's statistically less than 86% of businesses never transact. 86%. 14% of them transact, about 86% of them don't transact, or that means that they end up becoming insolvent or go into never realizing the cash from it. So in my generation, Generation X is where I'm at, XY, where you're going to put me at. I hear a lot of business owners who don't want to be like their dads and moms who are working when they're 60s and 70s. And so that's where our company, and Jeff specifically, works with business owners to outline where are we going. And Jeff, you and I saw through this COVID situation more than ever the need for personal planning for business owners. Because and you can attest to this, if you will, business owners who had done their personal planning, man, it's been my experience, Jeff, as I'm talking with them, that they're a little bit more stable, a little better stable and not as emotional during this particular crisis.
Well, and they've come to us and they've told us that, you know, we've reached out saying, hey, is everything okay? And they're like, sure, everything's fine. And we get that response quite a bit because they're in a position that they still have options available. And that's the best part about this, is we can take advantage and really capitalize on some of these circumstances if we're positioned correctly.
So friends, the question was, what's the difference between a non-qualified, an IRA, and a Roth IRA, and why should I choose one over the other? We answered what's the difference, and why you should choose one over the other is, it depends. And there's the answer of the decade that financial people will give you, because it really does depend. If you don't know your particular situation and you need some help, hey, reach out to us. Jeff, you jump on the phone with him. He will be more than happy to kind of guide you through some situations there. In your particular situation, you know, we have this saying in our office that my dad taught me years ago. He said, son, leave them better or leave them alone. And so at the end of the phone call, you're going to walk away at least knowing something that will put you in a better position. And we may say, hey, you don't need to hire us at this point. Or we may say, you know what, you do need to reach out to us. So if you want to go check out financiallysimple.com, you can look at work with us, and it becomes a direct link into our organization, and reach out and say, hey, I want to talk to that Jeff guy. He'd jump on the phone with you and walk you through the personal planning. More than ever, friends, especially with what we're dealing with on this global pandemic that we've dealt with, it's time to get our personal finances. We want to make sure our kids' shoes are shod. We want to make sure our families are fed. We want to make sure that we're taking care of these things. And oftentimes we do look at the business, but let's not forsake our personal finances. And with that, till next time, I'm Justin Goodbread here at Financially Simple. Jeff will be joining us to answer yet another personal financial question here in a couple weeks. Hey, friends, I realize life is hard, life is frustrating, life is complicated. Money doesn't have to be. Jeff's going to help our lives become at least more financially simple. Y'all make it a great day.